How dividend compound investing works. One of the best investments in dividend-paying stocks. Dividend investment is monotonous since it involves slow, dependable payouts in mature corporations. Steady returns are never dull. Dividend investing has several benefits, even though past generations had higher yields. So what is dividend income? Curious to know more? Now let's get deeper into this. Hello everyone and welcome to our channel. Remember to subscribe to this channel and press the bell icon to make sure you get all the updates. Let's start the video. Publicly traded companies can use income in three ways. It can invest in R&D, save, or pay dividends. Dividends are like bank interest for saving money. A 5% yearly dividend yield indicates the corporation will pay you $5 in dividends for one $100 share of stock. Dividend income is a reliable strategy to build a nest egg for many investors. When it comes time to turn lifelong savings into a retirement salary, a dividend income investing strategy can be crucial. Before investing in dividend income, learn the pros and cons. Primarily, companies modify dividends at will. They're also paid out more by larger, slower-growing enterprises. Smaller, less established companies are more likely to reinvest their revenues and grow their stock exponentially, which can help you build wealth. Dividend investing is likely if you hold stocks or index funds. 77% of S&P 500 equities pay dividends. S&P 500 dividend yields 1.70%, which is substantially higher than savings account, APYs, or treasury bond rates. Historical low. S&P 500 dividend yields averaged 3 to 5% throughout the 20th century. Companies are increasingly cautious with cash payouts, lowering dividend returns. Many reasons. Dividend stocks have limited competition due to poor savings accounts and bond yields. In the current interest rate environment, dividends are less attractive than if savings accounts paid 3%. In recent decades, tech corporations have grown in importance. Tech businesses prioritize investing in new goods for speedy expansion over paying shareholders. How dividend reinvestment boosts your returns. Despite these tendencies, dividends can enhance investing results. Reinvesting dividends to buy more stock helps your portfolio multiply. Reinvesting dividends can boost investment returns. You bought an S&P 500 index fund in January 2000 and kept it until September 2020. Stock price gains alone would have yielded a 4.2% yearly return and a 136% cumulative return. Nice, right? If you reinvested all dividends in the fund over the same period, your annualized return would have been 6.2% for a cumulative return of 247%. Reinvesting dividends nearly doubled your gains. Play with this calculator's numbers for even more spectacular effects. In January 1990, you invested $10,000 in an S&P 500 index fund. Price gains would give you $91,300 today. Dividend reinvestments would boost that to $180,000. What are the tax benefits of dividend investing? Dividend investing offers income investors tax benefits. The IRS treats dividends differently. Qualified dividends are taxed at the lower long-term capital gains rate, whereas ordinary dividends are taxed as regular income. Most U.S. corporations pay qualified dividends. For most investors, dividend income is taxed at the long-term capital gains rate after 60 days. Ordinary dividends from REITs and MLPs are taxed as regular income. Money market funds and similar vehicles offer regular dividends. IRAs and 401ks don't tax dividends until they're withdrawn. How to evaluate dividend stocks. Dividend yield helps identify the top dividend-paying stocks. Many services assist investors to locate high-yielding dividend stocks, but choosing the greatest yield might be misleading. Consider a stock that paid $5 in annual dividends and was worth $100 until recently. Despite paying $5 in dividends, the company's shares plummeted to $50 as its business struggled. From 5% to 10%, the dividend yield quadrupled quickly. Here, an increasing dividend yield indicates stress, not health. A company's board may need to reassess the dividend if its share price is falling. This emphasizes reliability when choosing dividend-paying equities. Is this company stable enough to maintain paying the promised dividends and perhaps even slowly increase them? The dividend aristocrats are a group of stocks that have consistently raised dividends. Real estate and utility stocks typically pay bigger dividends. The dividend payout ratio compares a company's earnings to its dividend payment per share and eliminates stock price volatility. If a corporation earns $2 per share in a quarter and pays a $1 dividend, its payout ratio is 50%. Low payout ratios may suggest more sustainable payouts or the need to increase dividends. A corporation with a payout ratio over 100% may need to decrease its dividend or face earnings pressure. However, an increasing payout ratio may suggest a healthy company in a mature industry with stable profits. This is it, everyone. So what do you think? Leave a comment and let us know. Thank you for watching the video. Don't forget to like the video and subscribe to the channel if you haven't already done that. Also, put on the notifications because the next video is going to be a great one.